But, thanks for having me. I've actually been meaning to come here for at least the last year. So my buddy Charles Hoskinson came out here and he said this was an awesome event and you have to go. Check it out. So here I am, lo and behold, about a year later. And actually a lot has happened on our project since then, so I think it's actually better. But I'm actually not here to talk about my project exactly. I mean, it's obviously woven into some of the conversation. But what I'm here to do is actually set a framework to help people, or at least pose some questions I think we really need to be asking as a community, as an industry, and really get to the heart about what's going on here. And number one, is it valuable? And if it's not, how do we steer it to make it something valuable? And just, let's get to the basics now and think about what we're trying to do. And the craziness of 2017 and, really 2017 is over. So now we have an opportunity to take a step back, chill out, and rethink some things. So my background, I'm actually a former military scientist on rehab now, and my academic work, I'm at the University of South Carolina, is in financial economics. So I was very fortunate to be able to work on my dissertation in Bitcoin asset pricing back in the day when academics thought it was utterly insane. But it ended up being a pretty good field to be in. So then from there I went and helped launch Zen Cash at the time, now Horizen. And one thing that I really want to get to, though, is what gets me going is the economics about what we're trying to do. So the presentation that you just saw was, I think, absolutely amazing in the sense that it gets to the primitives, really the kind of reason for why we're here. And that's actually very similar, overlapping motivation for me, why I got into this industry and what we're trying to do with Horizen. So lo and behold, let's get into some economics. So it's not too technical. In Horizen, we're trying to bring privacy to life. So we can get into a big conversation about privacy, but I also agree, I think transparency is a really valuable thing. So really what we do is we actually straddle the fence on that topic. We have extreme privacy with zero-knowledge cryptography, but we also have quite a bit of transparent type of access to our system and transparent type of transactions and data structures. So, okay, what I'm going to talk about, this is the grand agenda. We'll do a quick market snapshot. You guys are all crypto pros, so it's probably not too surprising for you. And then we'll talk about a taxonomy of the industry, because I think it's really important to have frameworks, and of course frameworks are approximations. But having the framework, whether you're an investor, enthusiast, or entrepreneur, helps you understand where you want to position yourself, maybe where you should position yourself, maybe you position your portfolio or whatnot. And disclaimer, this is not an investment pitch at all. We're not looking for investment capital, and I should probably have a similar disclaimer up there, from our general counsel. And then we'll talk about, then we'll really get into the economics and rethink value functions and objectives here. What are we trying to optimize over? Are we maximizing something? Are we trying to do some sort of general optimization? Are we profit maximizing agents or not? I'll show you, I argue that we kind of straddle the public goods sector quite a bit more, so the economics is a little different from what you would expect from a firm. Then we'll get into some macroeconomics, some considerations there, and then talk about funding models, because if you want to do anything in this world, you have to have resources to do it, right? So whether those resources are volunteer-based resources, like they were in the early days of Bitcoin, or they're actually paid resources, we have to think about funding models, and they're not all created equal. Some have some advantages over others. There's advantages, disadvantages, and there's probably some optimal point for whatever your functions are that you're trying to accomplish. And then we'll talk about stakeholders, because I think stakeholders are a very underrated topic for designing projects. And Bitcoin, the number one stakeholder in Bitcoin that actually tied to some real economics were miners, right? And beyond that, other people were considered volunteers. And then there's a whole different range of types of stakeholders, people that just run software, run full nodes of software, people that launch businesses on your system, people that just hold the coin for whatever reason. Maybe they love the project, maybe they think it's a speculative bet. All of these people, and probably 1,000 others in between, are different stakeholders. So I think we need to rethink the idea of stakeholders and how to incentivize them all in a way that gets them to do what we want them to ultimately do and participate and grow these networks. Then we'll get into some more economics and talk about Lorenz curves and just kind of distributional properties of these systems. Now, decentralization is an objective for us. Decentralization, to me, is not a religion. We do it for a purpose. We decentralize because we want to be censorship resistant. You can imagine that's important to a project that has privacy kind of at its core. But that's not necessarily what every project needs to consider. It's actually a trade-off. Centralized things tend to be more efficient than decentralized things. So whenever we make that leap to try to decentralize things, we are implicitly or explicitly making trade-offs on efficiency. And that could be okay. It's not a bad thing, not a good thing, depends what you're trying to do, of course. And then, as an asset pricer myself, we'll get into some asset pricing conversation here and think about valuations. Now, this is not a course on speculation or what are some good investments or bets out there, but to think, what are we actually, to think about the economics here in terms of what value are we creating, to which stakeholders that value flow, and then is there any rational way to try to price these things? And really, what are we trying to price in the first place? Okay, so lo and behold, let's have some fun. Of course, we're probably all very familiar when we wake up in the morning and check CoinMarketCap and cringe and, start your day either wonderfully or horribly. Markets went crazy for a period of time, and then they crashed. And of course, in Bitcoin, this has been going on since the beginning, and that's okay, right? It depends why you're here. I'm here, I got into the industry to try to make a difference in the world. So the price really isn't everything, but of course, price does matter. Especially for projects like ours. I'll show you our funding model later on, but it is tied to the price of these markets. So as the markets are going down, our ability to execute on certain things is actually correlated to that and declining as well. That being said, there is a lot of money flowing in. Okay, so crowdfunding went wild, actually. So crowdfunding gone wild and still going wild, actually, which I think is kind of weird in a bear market. There's still a lot of projects making a lot of money in their fundraising efforts. What happened was we had a new form of fundraising. Basically, projects could launch, tokenize their business or whatever they're doing, and sell those tokens to market. And sell all of the tokens to market, sell some pre-selected portion of the tokens to market, raise a lot of capital, and then do things with that capital. There are benefits to this. It opened up an entirely new funding channel to the world, which is probably a good thing. Right? In some sense, there's definitely value to this, where there's people all over the world that just did not have access for a variety of reasons to capital markets, and now they had a new channel to actually raise some capital. So that's the good side of the story. There's obviously a bad side to the story in which there could be a lot of waste, a lot of fraud, and so forth, and we're discovering a lot of this stuff, not surprisingly. Okay? But nonetheless, about $20 billion have been raised in this crowdfunding environment. That's real money. That's a lot of real money. And you might think that maybe the retail investors or maybe the investors in the crowdfunding environment, maybe they're not all that sophisticated, but the sophisticated guys, the VCs, have also put about $5 billion of capital into the industry since 2012. So there's real money flowing in. Okay, so people that do serious due diligence, who are custodians of other people's money professionally or of their own money because they've earned it in some fashion or whatnot, they're putting a lot of money into these markets. Okay, so there's something going on, and it's not really stopping. Okay, so I truly believe we're witnessing something kind of new, where Pandora's box has been opened, and we're probably not going back. So now let's think about how is this industry structured? Where's the money going, and how do we fit into it? Either as passive members of a community, or whether you're an investor, or whether you're an entrepreneur and thinking about how to build into it. I'm on the public blockchain side of the industry, right? So we're building a public blockchain, just kind of like Bitcoin's a public blockchain. A variety of the top 20 projects and whatnot that you're probably familiar with are public blockchains, but that's not all. There are companies that are building private ones, enterprise blockchains. There's people that are doing variants on blockchain technology. So if you have a set of characteristics that define your blockchain ecosystem, say privacy being a big thing for Monero or Zcash, that's one characteristic that defines your blockchain. There's 1,000 different characteristics that we can probably invent, and we probably will invent, and we're permuting on all of these. There's permutations on these going on all the time. So there's a lot of experimentation. There's smart contracting that we heard about, and this project's doing that, Ethereum being the classic first one that launched. And then there's this whole ICO and tokenization craze, where now businesses or people that are trying to do specific projects are tokenizing the projects and selling the tokens to markets, and that's their business. It's not necessarily a public blockchain. They're just running a business, and they happen to tokenize and be part of the industry. So out of all of this that's going on, let's think about what we're trying to achieve. All right, so I work on a public blockchain system, and I can tell you quite clearly we're not a profit maximizing agent. right? That's just not what we do. Like there's no profit stream that we're maximizing. One could think, and probably a lot of practitioners out there are thinking that they want to maximize their coin price or their token price, but that's not satisfying to me. I don't see that as a long-term sustainable thing. There's a lot of reasons for why a price might go up, and maybe that's pretty cool in the short term, but really we need to think a little bit deeper. What are we trying to achieve? So coins don't map to equity. That's a common thing that a lot of ICO investors are starting to realize. So as you're making investments into projects, you're not really always getting, or rarely ever getting, equity, actually. So there's not this mapping. If you buy into Horizen, you buy into Bitcoin, you're not getting equity in anything, right? You're getting some coin that represents some maybe slice of real estate on a blockchain, but really what is that? And this is what we need to start thinking about. So then when we put it in this context, what are we trying to optimize for? I think about this as well, as what do we want to maximize on our chain? Sometimes people ask us, how many transactions per day do you get on your chain? Do we want to maximize that? Does that even make sense? Do we want to really push hard to get as many transactions as possible per some time period on our chain? Maybe. I mean, that's some indication of value, right? But who does the value flow to? Miners collect fees, right, the way these things are structured right now. But do coin holders collect fees? Absolutely not. I mean, we could design that into a system, and maybe that's something that might make rational sense to do at some point as networks get more utilized and more economic values flowing over it. Maybe coin holders or token holders should get a slice of that, but right now miners typically do. So you can't really trying to value a project based on transaction throughput isn't necessarily kind of maybe a rational thing, just kind of on the surface of it. So then we think about, like for me, I think we're building public goods in a way, especially the public blockchain projects. So we're building utilities that we want to offer to society. In some way, we think we're benefiting society. And ultimately, like at Blockstack, what they're doing, they're building a set of utilities, and they're hoping that DApp developers are going to start building on top of that and create useful economics on top of that. So this is another way of thinking about it, is bringing real-world economies, maybe businesses, to run on our chains or operate on our chains in some useful way. Maybe that's another way to look at it. So I'm not sure though, and that's the thing is for me it's more about providing the public good, and then from there thinking about how we actually provide real-world value to people. Like, are we actually building apps that make people's lives better, or are we really just playing the hodl game, and pretending that we're actually benefiting society? So I think we need to do a better job. On the economic front, or the macro front, we're actually experimenting in a lot of different ways that I think are wonderful. So I got into Bitcoin because I loved the idea of separating money from state. To me, that was such a very elegant thing to do, to actually compete the idea of money. But that's not where, it doesn't stop there. Okay, so we're challenging everything. So we're, even with Bitcoin, and then we start launching 1,000 other projects out there, we're trying to experiment in every dimension we can. So people have been experimenting on the idea of money supply. Does money supply matter? Should we have an inflationary monetary system, maybe a slightly inflationary one, like Federal Reserve and other central banks try to do? Should we have deflationary ones, like gold bugs argue for? Should we have something maybe in between where it's just stagnant money supply, like Bitcoin offers? We really don't know, but I think it's a good thing for society that we're actually trying to experiment here and actually challenge things and try to see what works. So there are a few constraints that are really sacred and can't be challenged. But one thing that I really love about this is we're kind of ditching geographic borders or boundaries. So it's the idea of perfect market segmentation, where you launch a project and you no longer have to think about like the old days where if you launched a business, maybe you would get a license in the US and you would be targeting a US consumer market. Maybe you go international at some level of success or whatnot. But now we don't launch these things thinking about geographic borders. Like we didn't launch Horizen or Zencash thinking about targeting the US or EU marketplace. We launched this for a global venture, right? So these things are, I think, much better in the sense that we can target very specific markets. You could target a market for privacy like we initially did. Right, so this is what I mean by kind of perfect market segmentation, or at least the kind of migration towards more perfect market segmentation. So, and then rapid experimentation. So experimentation is really good for society if it's done in kind of you could of course think about some negative aspects of experimentation, especially if it's not maybe very responsible. But in general, on average, experimentation is a very good thing. And we should try to experiment with as many different business concepts as possible. So I think that's a really good aspect of what we're doing as an industry. Now, the other part of economics that matters a lot, like I said when we first started, was if you want to do anything in this world, you have to have resources. And Bitcoin and similar ecosystems, especially in the open source world, have relied traditionally on volunteer contributions. Whether you're volunteering code, whether you're volunteering your time to go evangelize the project and get out there and spread the word, you're volunteering implicitly. If you want to start a business, maybe here you're actually building on a payment rail or some other network utility, and that's good, but there are other ways to do things. So what we do is we actually have the block rewards go to more than just miners, and we have treasury pools, and I'll show you some of those details, but it's an incremental funding model. So funding models could be done in a lot of different ways. I love the responsible way that Blockstack did it, where they self-imposed constraints. That is abnormal. That is very, very abnormal. You do not see that in this industry very much. So what the ideal way to fund anything is to get the money as needed, right? In the theoretical perfect construct, you would fund things kind of just in time. You have a project and there's a certain milestone that requires certain funding for that moment of time. You fund it exactly the amount that you need. That's the perfect theoretical framework. We don't have that in reality. It's really hard to do, so we approximate. And the VC industry has been very good at approximating, where they would do kind of incremental funding. You would get some seed funding. Maybe you do a Series A, and if you hit certain growth milestones or success milestones, you get a Series B and so forth. What the ICO world actually did, I think maybe not necessarily for the best, is or a lot of projects were getting 100% of their funding that they want right up front. And I think this is actually maybe irresponsible, maybe not. If you self-impose constraints, that's more responsible, clearly. But really, as a manager, I have no idea how much capital I'm going to need for the next 50 years for the project, right? So why would I want to get all that money up front? I think there are there are some clear economic reasons for why giving money, 100% of a project's capital up front, could be dangerous. There's a ton of information asymmetries. I can guarantee you that the founders of the project and the managers know more about the project than you do as investors. There's moral hazard risks. There are projects that you fund and they're just straight up scams, of course. There's a lot of projects that mean well, but at the same time, they may not be perfect at time phasing their resource allocations. So I'm a fan of the incremental funding approach. And that's what we do. So every block that's mined, there's a little bit of Zen that goes into a treasury pool. Right now we have a nonprofit foundation set up to allocate the resources. We're actually democratizing that and building a voting system into our protocol. So token holders or coin holders can actually vote on resource allocation. That's one way to do it. So there's a variety of different ways to do funding allocations and resource your projects. Depending on what you're trying to do, there's probably different points of optimality. And then it comes to stakeholders. As I said earlier, there are a lot of different types of stakeholders out there. So miners were the classic first stakeholder group that Bitcoin did a great job at incentivizing in exactly the right way to get them to do what they were supposed to do. Then it came to the question of how do you pay developers, right? You want to get some really high quality talent and you want them to work full time on the project. How do you get people to do marketing for your project? How do you get people to do business development? Run operations, do some deep R&D that might not mature for the next 5 to 7 years, right? So this is where I think we have to think deeper about aligning incentives for all stakeholders. Okay, so the real equation that matters a lot is at the bottom, where the marginal benefit to any stakeholder group over all points of time should be greater than the marginal cost of their participation in your ecosystem. Okay, I mean, this is just fundamental basics, and we have to think about what are marginal benefits to participating, and then what are the marginal costs of participating. Time's a cost, investing, or parting with your capital is a cost. So ultimately, we need to align things properly. We have a very simple model, and it's probably, I can guarantee you it's not perfect. It's a first approximation at what we think is something, maybe a step in the right direction, is that we break up the block reward to pay other stakeholder groups besides just miners. We have 2 different node classes that do different types of work. And then we have a treasury pool, which funds our team, funds actually some some really deep R&D projects. We have a few of them with IOHK, with Charles, who came to speak to you guys as well. So we can do this stuff because we have funding, and I know that we'll have funding for the next 100 years because it's coming out of our block reward. So this, to me, is more sustainable, it's incremental, it's more rational, because if we do a good job, the market rewards us by the value of the coin going up. This is just one of the funding models that you can consider, and of course you can augment this in different ways. We should probably think about, as an industry, playing around with these different partitions. It doesn't have to be 10% to a treasury pool, 10% to a particular node class. We could even add a dozen other stakeholder types up there. I love the idea of actually paying app developers to build apps and having them get directly a portion of the new coin emission. I think that's a brilliant idea. Things like that we need to experiment on, I think, at a much deeper level. All right, so yeah, I mean, we think about a whole bunch of different stakeholder groups as well, but incentive compatibility is really the big point of it all. And then we can't have an economics talk without talking about distributional aspects of a blockchain ecosystem. So, and this comes down to decentralization or centralization. And what do we mean by that in the first place? So Balaji, from what was 21Co, turned it to Earner.com, and then got purchased by Coinbase. He came up with a great model of actually breaking public blockchain projects into subsystems. He had 6 subsystems. I think we could add a couple of others in there, maybe governance and funding models being others. But if you do just a really basic kind of distributional analysis, like a Lorenz curve, to think about what portion of whatever subsystem you're talking about here. Maybe the coin supply could be a subsystem. The commits to your GitHub repository could be a subsystem, right? The number of nodes that are operating the system could be a subsystem. Exchanges could be a subsystem. Like, how many exchanges actually do you have operating that have majority of your coin supply? So it turns out these are some graphs for Bitcoin. And the difference between the green and the red lines are the red represent 51% kind of capture of whatever subsystem or each respective subsystem. And it's actually pretty centralized. Ethereum, Balaji also did it for Ethereum. It's the same exact story. Neither of them is very, very decentralized. I don't know if that's good or bad, but if you want to think about, maybe talk about decentralization as being important, you ought to scientifically start quantifying this concept and think about intentionally decentralizing across whatever dimension you think is important. So I think that's important for projects, especially in the public blockchain space, and particularly those that are interested in privacy and want to be censorship resistant. You should probably actively decentralize. So now, getting to the concept of valuations. We know that valuations were kind of crazy, at least ex post. We could look back at the market and say, okay, things have crashed maybe 70% from their highs, so maybe at some point there was some irrational exuberance going in the market. I don't know. Maybe there's some efficiency here, maybe there's not. But I can tell you, in academia, we have no idea how to price these things. You can't apply any standard asset pricing model. Like, here's a classic asset pricing equation where if you're going to price something, you want the price to be equivalent to the expected discounted marginal rate of substitution of consumption multiplied by the vector of payouts. Right? So that's the basis for asset pricing. And what's the vector of payouts for a blockchain project, for Bitcoin? Right? With the vector of payout, it's not like a company where you can do a kind of a pro forma estimate of cash flows and try to rationally discount those cash flows and come up with a valuation. That just doesn't exist in this industry. So how can you think now about tangibly coming up with a value? We know that coins don't equate to equity. Okay. Network fees don't go to coin holders. So clearly, coin holders, it makes no sense for them to think about network fees and discounting those and come up with some valuation metric, right? So really, the way that I look at this, and I've had debates with other finance academics where they try to kind of tease me a little bit and say Bitcoin should be worth 0 and cryptocurrency should all be all worth 0. And I come back and say, well, they're not, so why not, right? And then it gets into this endless debate. And the way that I describe it is we're creating basically virtual, kind of unpartitioned economies. So we're creating 1,000 new economies out there in the world. They're all opt-in. So you can basically choose to opt into the Bitcoin economy. You can choose to opt into the Horizen economy. And then we're creating real value on there. So we're doing basically peer-to-peer economies that don't recognize borders. And I think this is a beautiful thing. This is why I got into the industry, what makes me really excited. So whatever we talk about in terms of the technology stacks that we're building, I think that the ultimate goal should be to create real-world value in our little virtual economies. And how do you value a virtual economy? Well, that I don't have an answer to either, but like a good academic, I like to sit on the fence, and maybe you guys could tell me what the value should be. But there are actually some tangible things that we could talk about. So cryptocurrencies have some interesting properties from a valuation perspective. So they do hedge some state, or they have some state hedging characteristics, I should say, in the sense that they hedge jurisdictional risk. So if you're in, the classic case we always talk about in the industry is Venezuela, right? Or maybe the basket case in Argentina, where every 10 years they have a financial crisis. If you're in one of these jurisdictions, or Turkey when they had the attempted coup and the lira starts crashing, there was value to people to hold Bitcoin or cryptocurrencies, right? So there is this jurisdictional hedging function which has real world value. So at least the currency component, we can start to say, well, we can point to some things that do have value. They're uncorrelated to traditional asset classes. So this is something that I think the financial industry is starting to learn a little bit more, and fund managers are starting to get a little bit more interested in, is that Bitcoin and cryptocurrencies really have no correlation at all. Run the numbers. The correlation is almost down to zero. At least statistically, it's zero of correlation to real estate, corporate equities, bonds, gold, silver, really oil, anything you can think of. The correlation to Bitcoin is statistically zero, right? And this is a beautiful thing from a portfolio theory perspective, because you could drive down your portfolio volatility significantly by adding, crazy enough, a very volatile, risky asset by itself, but by it not being correlated to other assets in your portfolio, it actually drives down your total portfolio volatility. So for fund managers, this is a very elegant thing, and it has real-world value there. And potentially, and especially some of the early advocates for Bitcoin, we're talking about there being potentially negative correlation to economic shocks. So if you guys remember the what was it, the bail-in that went on in Cyprus, yes, the bail-in in Cyprus. I remember the Bitcoin community back then, the Reddit boards and all that were on fire, saying, look, Bitcoin's going up because of Cyprus and the bail-in. So maybe there is some kind of negative correlation to these shocks that hit there. And this is where, some of the gold bugs who migrated over to Bitcoin, now they view it as a hedge against like a global financial collapse. Maybe that's true. Maybe it's not. We don't know, right? Bitcoin's been around for 10 years. So you can't make these kind of predictions, or you shouldn't make them responsibly on 10 years worth of data. But it's at least interesting to think about that maybe there is some sort of very negative state of the economy, or global economy protection that you get out of these assets. Maybe there isn't. Maybe we're just crazy to even think that. But it does go into this kind of set of things that we consider potentially valuable. So tying it all together, like I said at the beginning, and I'll keep saying it, is Bitcoin opened the Pandora's box. Like there's no going back. Whether you love it, you hate it, it's not going away. So the way I like to look at it is let's start trying to make good use of it. And you see this in academic departments around the world now. I remember when I got into my department and I wanted to do my PhD research in Bitcoin, I was kind of laughed at, but because I was only a first-year PhD student, they let me do what I wanted. That was cool of them. Now they actually hired me back on as an adjunct faculty member to teach this stuff to the department. So you can see how things have gone kind of full circle. And now academic departments are actually taking this stuff seriously, and getting a PhD with some emphasis in this area isn't as crazy as it used to be. So the world is changing, especially when you hear about certain large companies entering the space. Wall Street wants to get into it now, right? There's a lot going on. There's big money flowing in. Companies like Bitmain are, claiming they're making $4 billion a year in profit. So there's something going on here. I don't think it's going away. I think we're witnessing the birth of a new asset class at a minimum, right? How big the asset class gets, that's still, TBD. But it is a global thing, right? Someone from the US could invest just as easily as someone from Vietnam in a cryptocurrency or some crypto assets, right? Those boundaries that traditionally existed for things don't exist in this sphere. So I think that it has much larger potential. The pie here will certainly, in my opinion, be much larger than it has been for traditional asset classes. And the idea of rapid experimentation across every single possible domain of what we're trying what we care about in the economy, I think is great. There's going to be a ton of waste and a ton of failed ventures. And like I always like to just, remind people, as in the VC world, 9 out of 10 investments are going to fail anyway. So if you look at the ICO world and you can see 9 out of 10 projects that are failing, that's actually not new. Like there's no new information there. If maybe there's some number statistically greater than that, that's still TBD. We don't know. But the act of experimentation is a really good thing for society nonetheless. So the way that I look at this is we're reinventing a new economy for the world. I think a more fairer, inclusive economy, potentially. Now, of course, there's a big difference between rhetoric and claims and goals versus actually executing on them and achieving things. So we could claim decentralization and fairness and all this stuff all we want, but also early adopters in this space really are part of this kind of, in a way, segmented tech community that has so many more resources and opportunities than other people that might be homeless on the street in whatever city you live in, right? So it's not perfect, and it's not going to be the answer to all of society's problems, but we can try to intentionally design these systems in a way that should be fairer and be relentless about trying to make them fairer as we go. So I think that this isn't something that will just happen because of good wishes and intents. I think it's something that we have to work on every single day. And technology does erode barriers, though, and traditional frictions to things, which is great. We advance, we create new wealth, we create new opportunities for people. But really, the magic sauce to make this happen is not just to have good intentions, but to actually get out there and try to make the world better every time. And I feel really dorky saying that, right? That's like a feel-good way to end a conversation. But of all of the stuff that we talked about and the economy that we're building here, we are trying to be intentional about it, and we are trying to make the world better, but we have a lot of problems that we have to overcome. Especially in the ICO world, there's going to be a lot of projects that fail, and people don't realize that they invested maybe too much money without understanding why they invested that. So we have to overcome these information asymmetries, these moral hazards, potential for fraud. I think we should get out there and try to self-regulate as much as possible. Put in these actually, look up to the projects that put in these self-imposed constraints to be ethical. I think that's something that's special and not common. But the regulators will circle around. They'll eventually come into the space. And if you're not doing that, they're going to probably come down not so positively on it. But overall, I think we're doing great things. And our project in particular, if you have any questions or whatnot, we embody the stuff that I'm talking about. We're trying to do the economics right, and we're trying to make a difference in the world in a fair, ethical way. And I think that that's important. So we have a great team, or segment of our team that's here today. The guys wearing the Horizen shirts with the big muscles. Nate, I'm talking about you over there. Come say hi to us. It's a good crew. I think our project, we kind of embody just being good people and trying to make the world a better place as we go and blending cool technology with it. So thanks for having me, guys. Sure, yeah. So, I mean, we're building some special technologies out there. So one that I'll be a little forward looking to say, because we have technologies that are operating right now on our mainnet that really aren't that unique. I mean, we have some unique elements in terms of like zero-knowledge cryptography. We weren't the inventors of that. Zcash was, right? But let's take it a step further and say, what would be a unique value proposition to Horizen? We are launching what I think will be the most interesting sidechain model on the market. One that will be fully generalizable, where we can essentially offer like a reference sidechain, so basically a whole separate chain that operates kind of in conjunction or tandem with our main chain, where you could do dedicated business ventures on a sidechain. So for instance, you could have a real estate business, say a tokenized real estate business that you want to run on your own chain, but you don't want to operate the chain completely independently yourself. You don't want to go out there and think about how you're going to do the distributed node architecture. You don't want to deal with security. What we're going to be releasing to market in Q1 of next year will be fully generalizable, where we'll have a reference, essentially a reference sidechain, and we'll have a bunch of different reference ones actually that are plugged in via a SDK or an API where now other businesses or developers can now start building in a way that's unique to them, but still we take care of the network security and we take care of a lot of the heavy lifting on the blockchain side. So that would be one thing. We're doing a variety of other stuff. If you want to check out our project, we're doing interesting stuff, research in distributed governance, which has been a problem. So we're trying to tackle some of the big problems in the industry, which is ambitious, but we're thinking long term. So we're tackling distributed governance with an on-chain liquid democracy voting system. We're dealing with scalability in a couple of different ways. So scalability via the sidechain model, which could be massive scalability if you do kind of dedicated sidechains for different things. So potentially if we were to enter the smart contracting space, or actually I like the simple contracting term a lot better, and that's really the way we look at it as well. Not Turing-complete scripting languages, but specialized functions that could do certain things. Doing that on sidechains is a great way to do that in a very scalable way. On-chain scalability, we've been doing DAG research, or this directed acyclic graph research, for the last 8 months. It's finally matured into a prototype system that works just really fast, right? So it's like, for those of you who are really familiar with the industry, there's IOTA, Hashgraph, and these other projects that do DAGs. It's really a generalization to blockchain. So instead of doing blocks in sequence, you could do a lot of blocks potentially in parallel. Ours is a block DAG, so not actually like a transaction DAG, technically. So things like that, I think, are unique to where we're going, to be really fast, really scalable, good distributed governance, but then also looking at the business use cases. So I think that those are the exciting aspects of what we're building in the next, say, 6 months. Yeah, it's much. That's actually why we rebranded. We were Zencash actually until a couple months ago, but really all the stuff that I just talked about has nothing to do with currency. Right? So that's why the cash stopped making so much sense. Yeah, of course. So we're trying to be very active in the public policy discussions as well, and trying really, to me, it's about educating regulators and trying to help them understand what we're trying to do. The thing is, I think that if Bitcoin or Horizen or any project becomes so super successful, I do think that entrenched interests might see it as a threat and try to push back on it. I'm hoping it's kind of like an Uber model, where we just get out there and people love it so much and they couldn't live without it, that there's kind of like a popular sentiment for, you can't take this away from us. I hope, but of course that's like a very optimistic way of looking at it. But really, also think about what are the justifications to try and stop stuff like this. At least in the United States, code is protected under kind of free speech laws, or the Amendment for Free Speech. So we have some protections legally. Whether or not the Federal Reserve decides to overrule those, I mean, I have no idea. It'd be really tough. I hope not. I'm on the optimistic side of it, though, but I definitely agree, share your concern.